Profits are climbing, but so are the demands on Rockwell Land's cash. It's a contradiction at the heart of the first quarter: operational strength paired with sharper liquidity pressures. For years, Rockwell has promised investors more than just buildings. They've offered premium addresses and a lifestyle brand, and so far, the commercial momentum holds. First quarter revenues surged 45% to 6.455 billion pesos. Net income advanced 52%, parent net income up 67%. Led by successful launches and the consolidation of Alabang Commercial Corporation, every major segment delivered growth. Lease income, retail operations, and commercial development each posted impressive gains. ACC's contribution already reshapes earnings, giving Rockwell a smoother, less cyclical revenue base. But growth comes with obligations. Rockwell faces a 7.2 billion pesos current payable for the ACC acquisition and 9 billion pesos in near-term borrowings. Together, these total 16.2 billion pesos within the current cycle. Cash and equivalents stand at 12.3 billion pesos, covering about 76% of these demands, even before factoring in everyday expenses and construction needs. Underlying the optimism is the reality that liquidity is tighter and working capital must be carefully managed. Interest expense is rising, ballooning to 711 million pesos, up by 2/3 versus last year. Rockwell strengthened its liquidity by issuing 10 billion pesos in bonds this March, with proceeds bolstering cash reserves and improving ratios. Yet, stronger liquidity has its price: a larger debt stack and heavier recurring interest burden. The balance sheet looks solid, but for property developers, asset value doesn't always translate to immediate cash. Receivables, contract assets, and inventories provide comfort, not instant flexibility. Timing and cash flow are the keys. Construction spending topped 3.2 billion pesos, mainly for future-focused projects. These investments drive tomorrow's revenues, but demand cash up front. In the best case, Rockwell manages refinancing smoothly, leverages bond proceeds, and continues its construction rhythm. In a less benign scenario, collections lag and interest costs rise, forcing careful prioritization. Margins remain robust, with EBITDA up 42%. The company isn't distressed, it's transitioning to a more complex, capital-intensive platform with heavier recurring income streams and obligations. ACC seems a shrewd acquisition, but every deal has its tail: payables, debt maturities, and operational risks. What matters most for investors isn't simply if Rockwell can pay, but how it manages timing, project funding, and flexibility. Property development is a choreography of cash moves. When collections are brisk, growth appears seamless.
When obligations cluster, strategic choices become vital.
Rockwell's first quarter provides comfort in demand, growth, and commercial expansion. It also serves caution. Liquidity now commands center stage. Investor vigilance is warranted, as refinancings and project collections will determine the company's tempo. Growth continues, but its carrying cost is higher. Prestige is built slowly, funded continuously, and managed with care.